Let me ask you something honest. Think about March 2020. COVID just hit. The market dropped 34% in 33 days. The fastest crash in American history. Your 401k, your Roth IRA, your brokerage account, all of it down. What did you do? If you pulled out, if you sold everything, moved to cash, told yourself, I'll get back in when things stabilize, you're not alone. Millions of people did exactly that. But here's what happened next. The market didn't just recover, it roared back. By August 2020, just 5 months later, the S&P 500 had fully recovered. And by end of 2021, it was up over 100% from the crash low. The people who stayed in doubled. The people who panicked sold at the bottom and waited for things to feel safer. They locked in losses and missed one of the greatest recoveries in market history. So the question isn't, was the market scary in March 2020? It absolutely was. The question is, why do we keep making the same mistake, crash after crash, cycle after cycle? Today, that's what we're going deep on, because the enemy isn't the market. The enemy is what happens inside your own head. I want to tell you about a guy, smart, educated, 26 years in the finance industry, a fund manager who literally advises other people not to panic during market downturns for a living. This is a man who gives speeches about emotional discipline, who has sat across the table from terrified investors and calmly explained why they shouldn't sell, who understands more than almost anyone that the worst thing you can do in a market crash is panic. And in 2019, he was forced to borrow money to exercise his stock options. Standard stuff in the finance world. The tax laws in his country required it, so he borrowed, paid the tax, locked in the equity, and told himself, 6 months. I just need to hold on for 6 months. Then the stock goes liquid. I sell some shares, pay back the loan, and I'm fine. 6 months. That's all he needed. Then March 2020 happened. The market crashed 40%. His stock, which he had borrowed against, which he had paid taxes on, the very thing he couldn't sell yet, went from $10 to $5. He had $1 in equity, $3.50 in debt he owed to pay that tax, and now the $10 he was counting on had become $5. Every morning he woke up and the math was horrifying. And this is the part that gets me. This is the part I want you to really sit with. He said, what if I panic? What if I say, get me out of this, close this position, I can't take it anymore? That was the real risk, not the market falling. Me, every instinct in his body was screaming to do something, anything, make it stop. But he knew, because 26 years had taught him that the only move was to grit his teeth, sit still, and wait. And by the end of 2020, the market recovered, his stock recovered, the loan got paid, he was fine. Those 6 to 7 months, he said it was one of the hardest experiences of his professional life. And this guy, again, does this for a living. So what hope do the rest of us have? Actually, a lot. And that's what today is really about. Here's the first thing you need to understand about your brain and money. Your brain was not built for the stock market. It was built for survival. And survival means when something is going wrong, you respond immediately. You don't wait. Waiting gets you eaten. So when you open your brokerage app and you see red, your portfolio down 15%, 20%, 20%, your brain does exactly what it evolved to do. It screams, do something right now. Stop the bleeding. But here's the problem. The stock market isn't a predator. It's a scoreboard. And scoreboards are brutal on the human psyche. Think about it this way. You're watching the Super Bowl. Your team is down by 14 at halftime. What happens in your head? Doubt creeps in. You start building the case for why they can't come back. We never win when we're down this much. The quarterback has been terrible all season. This is just typical. Honestly, you start drawing conclusions. And the moment you commit to that story, the moment you decide it's over, you emotionally check out. You stop paying attention. And if your team actually mounts one of the greatest comebacks you've ever seen, you almost miss it. Or worse, you turned it off at halftime. The stock market does this to people constantly. In 2022, the S&P 500 dropped about 19.4%, its worst year since 2008. Financial media was apocalyptic. Recession incoming. Tech bubble burst. Is this the beginning of a decade-long bear market? People panic sold. They moved to cash. They waited for things to stabilize. 2023, the S&P was up 26%. The scoreboard looked terrible in 2022. So people drew conclusions, and they paid for those conclusions in 2023 gains they never saw. There's a line I keep coming back to, simple but devastating. The stock market is not a T20 cricket match. It doesn't end in 20 overs. There is always another day. Now, obviously, us Americans, we don't follow cricket. But you know what the American version is? It's not the Super Bowl. It's not even a season. It's more like a career. Michael Jordan got cut from his high school basketball team. At that moment, the scoreboard said, not good enough. Anyone who drew conclusions based on that scoreboard would have missed the greatest basketball career in history. The market is a career, not a game. Okay, so now I want to get into the single biggest mental mistake investors make, and it's not what you think. Most people believe that risk is volatility. Risk is the scary red numbers. Risk is the market swinging up 3% Monday and down 4% Tuesday. Risk is watching your portfolio value fluctuate by thousands of dollars in a single afternoon. That's not risk, that's weather. Think about it this way. You own a house, and one afternoon there's a massive storm. Wind, rain, hail, dramatic and terrifying. Your neighbor calls you panicking. The storm is destroying property values. We need to sell now, but your house is structurally sound. The roof is solid. The foundation is good. Nothing is actually damaged. Do you sell? Of course not. Because you understand the difference between a storm passing through, which is temporary, and your house's foundation cracking, which is permanent damage. Volatility is the storm. It feels dangerous. It looks dangerous on your phone screen. But if you own a diversified portfolio of solid companies, the storm passes. It always passes. Now, actual risk, real, dangerous, capital destroying risk, that's two things. First, betting everything on one company, because sometimes companies don't recover. Enron didn't recover. Lehman Brothers didn't recover. Blockbuster didn't recover. If you had everything in any of those companies, the storm wasn't weather. It was a permanent loss. No amount of waiting brings it back. Second, making emotional decisions during the storm. This is the sneaky one, because this is how people voluntarily turn temporary weather into permanent loss. When the market drops 30% and you panic sell, you've done something precise and irreversible. You've locked in that 30% loss permanently. And now you have a new problem. When do you get back in? Because if you sold at the bottom and the market recovers 40%, you have to time re-entry perfectly just to break even, and almost nobody does. Here's the uncomfortable math. Let's say you had $100,000 invested in a broad index fund. Market drops 30%. You now have $70,000 on paper. If you stay put, you need a 42% recovery to get back to $100,000. Markets have done that many times. But if you sell at $70,000 and sit in cash while the market recovers 42%, you're still at $70,000. You turned a temporary loss into a permanent one with one decision made in fear. The market didn't destroy your wealth. The storm of emotion did. I want you to think about someone you know. Maybe it's you, who made a financial decision at the worst possible moment, sold in 2009 at the bottom of the financial crisis, moved everything to cash in March 2020, bought crypto at the peak in 2021 because everyone was getting rich and it felt safe. Every one of those decisions made perfect emotional sense in the moment. None of them made financial sense, because the brain that's trying to protect you from danger, it was not designed to distinguish between a lion chasing you and your Robinhood app showing red. To your nervous system, they feel identical. Okay, so we've established the problem. Your brain treats volatility as danger. It makes you panic at exactly the wrong time. And panic selling turns temporary losses permanent. The obvious solution sounds simple. Do the opposite. When everyone is panicking, be calm. When everyone is buying in a frenzy, be skeptical. When the headlines scream catastrophe, stay put. Warren Buffett has a famous version of this. Be fearful when others are greedy, and greedy when others are fearful. Great quote. You've seen it on 100 Instagram posts. It's been quoted so many times, it's basically wallpaper. But let me ask you this. How many people actually do it? Not many. And here's why it's almost impossibly hard. Because when everyone around you is panicking, the rational interpretation, based on all available evidence, is that something genuinely catastrophic might be happening. The consensus isn't always wrong. The crowd isn't always irrational. But here's the deeper insight. By the time something becomes consensus, By the time everyone agrees it's a great investment, or everyone agrees the market is doomed, the market has already priced that in. Think about what a stock price actually is. Right now, in this moment, the price of any stock you can name reflects the combined opinion, fear, hope, and analysis of every fund manager, every algorithm, every retail investor who has looked at that company. It's not just one person's guess. It's millions of people's best guess, aggregated instantly. So when you hear AI stocks are going to explode on every podcast, every financial show, every Twitter thread simultaneously, the explosion has already happened. The price already reflects that excitement. You're not getting ahead of the trade. You're becoming the trade. This is why the smartest contrarian move when something becomes unanimous is to wait. Not necessarily to short it, not necessarily to bet against it. Just step back, let the consensus run, watch. Because world is always more complicated than a single unanimous narrative. Here's one that hits close to home for a lot of Americans right now. In late 2021, you couldn't go to a dinner party without someone talking about crypto. Your coworker was quitting to day trade NFTs. Your uncle was telling you to buy Dogecoin. Financial influencers were saying this was the future of money with complete certainty. It was consensus. And by November 2022, Bitcoin was down 75% from its peak. Billions in wealth evaporated. Again, this isn't about crypto specifically. It's about the pattern. The moment everyone agrees on something in investing, danger is usually closer than you think. Let me tell you one more story. This one is quieter, but it might be the most powerful thing in this entire video. There's a family. Father was an investor. Nothing crazy, just methodical. Bought shares of solid companies across a few decades. Reliance, some blue chips. Held them. Didn't check them obsessively. Didn't panic sell during downturns. Just held. He passed away young. And when his family went through his papers years later, they found stock certificates. Companies they'd forgotten about. Some that barely existed anymore. But others, the solid ones he'd quietly held, had compounded for a decade. 15 years, untouched. What had been modest investments had become significant wealth. Now here's what I want you to notice. He didn't time the market. He didn't have a sophisticated algorithm. He didn't watch CNBC every morning. He didn't move to cash when things got scary. He simply owned real businesses. And he let time do what time does. This is the truth about wealth building that the financial media has no incentive to tell you, because it's boring. The single most powerful thing in your financial life is not your stock picks. It's not your timing. It's not whether you bought the right sector at the right moment. It's whether you stayed. The historical average return of the S&P 500 is roughly 10% per year. $10,000 invested at 25 becomes about $174,000 at 65. Not because of brilliant trading, not because of perfect timing, because of compounding, uninterrupted. But here's the thing about that number. It's an average. Inside that 40 years, there are crashes. There are years down 30%. There are recessions and bear markets and moments of genuine terror. The 10% average only happens to the people who stay through the bad years, the people who leave during the storms, who draw conclusions from the scoreboard, who confuse volatility with permanent loss. They don't get the 10%. They get something much worse. Okay, so let's bring this home. If you're watching this and you recognize yourself anywhere in this video, if March 2020 was painful, if 2022 hurt, if you've ever made a decision in a financial panic that you later regretted, here's your framework. 1. Separate weather from damage. Volatility is weather. Your portfolio going down 15% in a market correction is weather. A company you're heavily concentrated in going bankrupt is damage. Know which one you're looking at before you act. 2. Never look at a scoreboard and draw a conclusion about the final score. The market doesn't end. There is no halftime. There is no final whistle. As long as the underlying economy is producing value, and it always has, the scoreboard will move in your favor if you give it time. 3. When everyone agrees, slow down. Not because the crowd is always wrong, but because consensus is already priced in. The edge is never where everyone is looking. 4. The most important financial decision you'll make is not what you buy. It's whether you stay diversified, patient, steady. through the storms, through the scary headlines, through the 3 a.m. moments where you're tempted to check your portfolio and do something, anything to make the anxiety stop. Stay, because the market always looks forward, and so should you. If this hit different than your usual financial content, that's intentional, because most of this stuff isn't about spreadsheets. It's about the 6 inches between your ears. Get that right, and the rest gets a whole lot easier. Drop in the comments, what's the hardest financial decision you've ever had to sit still through? I read every single one. If you want to go deeper on building the kind of long game mindset we talked about today, subscribe, hit the bell, and I'll see you in the next one.